Make or buy decisions are important short-term and strategic management accounting decisions that determine whether an organization should produce a product or service internally or obtain it from an external supplier. Within the program framework, these decisions require careful evaluation of relevant costs, relevant revenues, operational capabilities, and strategic implications. Organizations frequently face make or buy decisions involving components, raw materials, support services, logistics, information technology, and manufacturing processes. The objective is to select the option that creates the greatest value while supporting organizational goals. Effective analysis helps management improve efficiency, reduce costs, optimize resource utilization, and enhance overall competitiveness. The foundation of make or buy analysis is relevant cost assessment. Management accountants compare the future costs that differ between producing internally and purchasing externally. Relevant costs typically include direct materials, direct labor, variable overheads, avoidable fixed costs, transportation expenses, quality control costs, and supplier charges. Costs that remain unchanged regardless of the decision are considered irrelevant and should not influence the evaluation. By focusing on incremental costs and benefits, managers can identify the true financial impact of each alternative. This approach ensures that decisions are based on economic reality rather than historical accounting figures or sunk costs. Opportunity costs are also important in make or buy decisions. Internal production may require the use of scarce resources such as labor hours, machine capacity, factory space, or management attention. If these resources could be used more profitably elsewhere, the foregone contribution represents an opportunity cost that must be included in the analysis. For example, if outsourcing a component allows production facilities to manufacture a higher margin product, the additional contribution generated becomes relevant to the decision. Considering opportunity costs helps management evaluate resource allocation more effectively and identify alternatives that maximize overall organizational value. Although financial considerations are important, make or buy decisions should not be based solely on cost comparisons. Qualitative factors often have significant strategic implications. Management must evaluate supplier reliability, product quality, delivery performance, confidentiality concerns, intellectual property protection, customer requirements, and operational flexibility. Outsourcing may reduce costs but increase dependence on external suppliers or expose the organization to supply chain risks. Conversely, internal production may provide greater control over quality, scheduling, and innovation. These non-financial factors can influence long-term performance and therefore must be considered alongside quantitative cost analysis. Modern business environments have increased the importance of make or buy decisions as organizations seek efficiency, specialization, and flexibility. Advances in technology, global sourcing opportunities, and complex supply chains have expanded outsourcing possibilities across many industries. Organizations frequently evaluate whether external suppliers can provide goods or services more efficiently than internal operations. At the same time, digital transformation and automation may reduce internal production costs and alter previous outsourcing decisions. Management accountants play a key role by providing relevant information that supports balanced evaluations of both financial and operational implications. In conclusion, make or buy decisions are critical management accounting decisions that require careful consideration of relevant costs, opportunity costs, and strategic factors. Effective analysis focuses on future costs and benefits that differ between alternatives while excluding irrelevant and sunk costs. Opportunity costs ensure that scarce resources are allocated to their most valuable uses, while qualitative considerations address issues such as quality, reliability, flexibility, and risk. By combining financial analysis with strategic evaluation, organizations can determine whether internal production or external sourcing offers the greatest overall benefit. Consequently, make or buy decisions contribute significantly to efficiency, profitability, and long-term organizational success.